In 1982, as a 6-year-old kid, I started working at American Express. On my first day, my boss told me something: Jamie, the survivors in this business aren't the smart ones, they're the disciplined ones. From that day to this, I've been in the banking industry for over 40 years. I run the world's largest bank for $1 trillion in assets. And the 5 rules I'm going to tell you today are the rules that got me here. But more importantly, these rules kept me standing during the 2008 crisis, protected our clients, and made JPMorgan come out stronger. Today, I'm sharing these 5 rules with you, because when the next economic storm comes, and it will come, the survivors will be those who know these rules. You know, there's a saying on Wall Street: markets humble you. And it's absolutely true. When I started my career, I thought I was pretty smart. Good school, good degree, big ambitions. But in those first few years, I learned that success in finance doesn't come from intelligence, it comes from discipline. In 1987, the market crashed. Black Monday. The Dow Jones dropped 22.6% in a single day. People panicked, lost their fortunes in the 1,990 seconds. The dot-com bubble inflated, then burst. Billions of dollars evaporated. In 2008, Lehman Brothers collapsed. Bear Stearns was sold. The global financial system came to the brink of collapse. And now, in 2025, the same anxieties again. Inflation, recession risks, geopolitical tensions, they're all back. But one thing hasn't changed through every crisis. Some people stayed standing. Some even got richer. How? That's what we're talking about today. 5 survival rules I learned over 40 years, tested managing $4 trillion, and proved during crises. Rule 1, cash is king, but most people don't understand this. Everyone talks about investing: stocks, crypto, real estate. Put your money to work, they say. And that's true to a degree. But I'll tell you the truth, your most important asset is cash. Liquid, on hand, immediately available cash. Why? Because when crisis comes, the paper value of your assets means nothing. I saw this in 2008. People had millions in their portfolios, but they couldn't sell. The market had collapsed. There were no buyers. When they tried to liquidate, they had to sell at 50%, 60% losses. Result? People who looked wealthy went bankrupt. Meanwhile, what did people holding cash do? They waited, they watched for opportunities, and they bought quality assets at rock bottom prices. At JPMorgan, we always maintain a strong cash position. Why? Because opportunities come at unexpected moments, and you need to be ready to seize that moment. Now, you'll say, but Jamie, holding cash loses value to inflation. True, but in a crisis, the value of cash multiplies. In 2020, when the pandemic hit, markets dropped 35%. People waiting with cash bought Amazon, Apple, Microsoft at incredibly discounted prices. 6 months later, their portfolios gained 50, 60% in value. That's the power of cash. So how much cash should you hold? My recommendation: minimum 6 months, ideally 12 months of living expenses. That's too much, you might say. But let me tell you, people who lost their jobs in 2008 lost their homes within 3 months because they had no cash. What does 12 months give you? Time. Time to think. Time to make decisions without panic. And that's priceless. Let me add this: cash isn't just for crisis, it's for opportunity. I always say opportunities come to everyone, but only the prepared catch them. If you have cash, when the market crashes, you're a buyer. If you don't have cash, you become a seller. And being a seller in crisis time is the worst position. So, rule 1, cash is king. Always stay in a liquid position. Rule 2, debt is a tool, not a weapon. Use it right or it destroys you. There's a joke on Wall Street: debt either makes you rich or destroys you. There's no middle ground. And it's completely true. Debt is the most misunderstood concept in the financial world. Some people run from debt in fear. Some over-leverage, then drown. The truth is, debt is neither bad nor good. Debt is a tool. And like any tool, how you use it matters. Think of a knife. You cook with it, but if you misuse it, you get hurt. Debt is the same. At JPMorgan, we lend trillions of dollars every day. And what I see is this: Good borrowers get rich, bad borrowers sink. So what's the difference? Good debt. Good debt enables you to acquire an income generating asset. Example, you buy a house, rent it out. The rent covers your mortgage, even leaves extra. That's good debt. Example, you take a business loan, buy equipment, production increases, income increases. That's good debt. Good debt creates leverage. You have $100,000, you borrow $200,000, you invest $300,000. If this investment returns 10%, you earn $30,000, but you only put in $100,000. So your return is 30%. That's good debt. Bad debt. Bad debt is debt taken for consumption. It doesn't generate income, only creates expenses. Taking a credit card vacation. Bad debt. Taking a loan to buy a luxury car. Bad debt. Short-term borrowing at high interest. Very bad debt. Why bad? Because these don't generate income for you, but create costs. And in crisis times, these costs drown you. What happened in 2008, people had over-leveraged on their homes, 100%, even 120% mortgages. Then home prices dropped. They couldn't make mortgage payments. Foreclosure came. Millions lost their homes. Why? Because leverage worked in the wrong direction. My rule is simple. 1, don't take consumption debt. If you do, pay it off as quickly as possible. Credit card debt, 20% interest, ridiculous. Close it immediately. 2, if you're taking investment debt, be conservative. Don't use excessive leverage. Don't borrow so much that a 20% market drop drowns you. 3, always borrow what you can pay. Don't let more than 30% of your income go to debt. Otherwise, you can't breathe. Let me tell you a story. In the 1,990 seconds, I had a friend in real estate. Very smart, very ambitious. He bought 10 houses, all mortgaged. On paper, he was a millionaire. But in 1991, recession came. Rents fell. He couldn't make mortgage payments. He lost all the houses. And not just the houses, credibility, his reputation, everything. Why? Because he was over-leveraged, had no safety margin. On the other hand, I had another friend. He was also in real estate, but much more conservative. He bought 3 houses, paid 50% down. His mortgage was very low. When recession came, rents fell, but he could still pay. And 2 to 3 years later, when the market recovered, he got rich. That's the difference. Debt is a tool. If you use it right, it accelerates you. If you use it wrong, it destroys you. Rule 3, diversification is protection. Don't put all your eggs in one basket. The most common mistake I hear on Wall Street, I really trust this stock, I put everything in it, or real estate never goes down, all my money is in houses, or crypto is the future of money, I'm going all in on Bitcoin. Result? Disaster. Look, I'm not saying don't buy stocks, don't buy houses, don't buy crypto. No, buy them. But don't put everything in one place because nobody knows what will happen in the future. Nobody. In 2000, everyone said the internet will never end. Then the dot-com bubble burst. NASDAQ dropped 80%. In 2006, everyone said real estate never goes down. Then in 2008, home prices dropped 40%. In 2021, everyone said crypto is going to the moon. Then in 2022, Bitcoin dropped 70% every time. The same story. Overconfidence, overconcentration, then collapse. You know what I care about most at JPMorgan? Risk management. We look more at how much loss risk we're carrying than how much money we're making. And the heart of risk management is diversification. What does diversification mean? Spreading across different asset classes, different sectors, different geographies, different instruments. Why? Because everything doesn't collapse at the same time. While stocks fall, bonds might rise. While the dollar weakens, gold might strengthen. While the tech sector falls, the healthcare sector might hold. That's the power of diversification. Remember 2008, those with only stock portfolios lost 50%, but those with stock plus bond plus cash mix lost only 25%. And more importantly, they recovered much faster. So how do you diversify? My recommendation, 1, asset class diversification, 40-50% stocks, 20-30% bonds for stability, 10-20% real estate for inflation protection, 10-20% cash for opportunity, 5 to 10% alternatives, gold, commodities, etc. 2, Geographic diversification. Don't just invest in America. Europe, Asia, emerging markets. The world is big. Opportunities are everywhere. 3, sector diversification. Technology, healthcare, finance, energy, consumer goods, a bit from each sector. Why? Because sectors are cyclical. One period tech rises, another period energy. If you're in all of them, you profit from every period. 4, time diversification. Don't invest all your money at once. Spread it over time, dollar cost averaging. Why? Because market timing is impossible. But if you spread over time, you get a good average price. Let me give an example. In 1999, I knew someone who put all his retirement money in one tech stock. In 2000, that stock dropped 95%. The man lost 30 years of savings. At the same time, someone else spread his money across 10 different stocks. Some fell, but some stayed standing. Result, 30% loss. Painful, but not catastrophic. 10 years later, the second person recovered, even got richer. The first person is still working for retirement. That's the difference diversification makes. And let me add this. Diversification doesn't reduce your returns. It reduces risk. Yes, if you go all in on one stock and that stock goes up 500%, you make a fortune. But 90% of the time, that stock won't rise and you'll lose. Diversification is the way to win long term. Rule 4, you can't time the market. Stay in time. One of the biggest illusions, I'll buy low and sell high. Everyone wants this, but almost nobody can do it. Why? Because market timing is impossible. I've been in this business for 40 years. We manage trillions in assets. We have thousands of analysts, the most advanced models, the best information. And let me tell you, even we can't consistently time the market correctly. So how can an individual investor do it? They can't. But the good news is they don't need to, because there's something much more important than market timing. Time in the market. Time in the market beats timing the market. There was a study that examined the S&P 500 for 30 years, from 1,990 to 2020. If you stayed in for 30 years without leaving, annual average return was 9.9%. But if you missed the best 10 days, it drops to 5.6%. If you missed the best 20 days, 2.5%. If you missed the best 30 days, almost zero. In 30 years, missing just 30 days wipes out all returns. And guess when those best days come? Usually right after the worst days. So if you panic and sell, you also miss the recovery. An example from 2008, March 2009, the market's at the bottom. Everyone's scared. Everyone's selling. But in the 12 months after March 2009, the market rose 69%. 69%. People who missed that time missed the 10-year bull market or 2020 pandemic. In March, the market dropped 35%. Everyone panicked. But from April, December, it rose 68%. See? The darkest moments are the best buying opportunities, but you only catch this if you stay inside. So what should you do? 1, think long term. If you're investing for the 20th of October, 20, 30 years, this year's fluctuations don't matter. Noise on the chart. 2, invest regularly every month, same amount. Market up, invest. Market down, invest. Make this automatic. Don't make emotional decisions. 3, don't sell when crisis comes. When everyone's selling, you hold. Even buy, because crises are temporary. Recovery is permanent. A story. 1,987 Black Monday. Market dropped 22% in one day. Imagine the panic. But 2 years later, market recovered, reached new highs, or 2000.com, NASDAQ dropped 80%, 3 years of bear market. But after 2003, 6-year bull market, new highs, or 2008, 57% drop, worst crisis. But in 2013, full recovery. Next 7 years, incredible gains. See the pattern? After every big drop, a big rise comes. But only those who stay inside win. Sellers, they lose because they sell at the bottom and buy at the top. That's the biggest mistake. So my rule, you can't time the market, stay in time. Rule 5, emotional discipline is everything fear and greed will destroy you. The last rule, perhaps the most important, because even if you know the other 4 rules, if you don't have emotional discipline, you can't apply them. Finance is psychology. It's more about emotions than numbers. And the 2 biggest enemies, fear and greed. Warren Buffett's famous quote, be fearful when others are greedy, be greedy when others are fearful. But in reality, everyone does the opposite. When the market rises, everyone gets excited, buys, FOMO. I want to win too. When the market falls, everyone panics, sells. I don't want to lose more. Result, they buy high and sell low. The exact opposite. I saw it in 2008. People panic sold in March 2009 at the bottom. I saw it in 2021. People went all in on meme stocks, crypto at the peak. Every time, the same story. So how do you gain emotional discipline? 1, make a plan, stick to the plan. Determine your investment strategy beforehand. What will you buy? When will you sell? How much risk will you take? Then, whatever your emotions say, stick to the plan. Emotions are temporary. The plan is permanent. 2, stay away from media. If you watch the news every day, you'll panic because media always tells crisis stories. Market crashing, recession coming, financial system at risk. These are written for clicks. Most aren't real. Instead of daily news, check your portfolio quarterly. That's enough. 3, read history, study past crises, and 8, 1,929, 1,987, 2,000, 2008, 2020. The same thing happened in all. Drop, panic, then recovery. If you know this, you won't panic at the next drop because you know this too shall pass. 4, be long-term focused. If you're investing for 20 years from now, why should this month's 10% drop concern you? It shouldn't. Keep your eyes on the goal. There will be ups and downs along the way. 5, be honest with yourself. Know your risk tolerance. If you'll panic at a 20% drop, don't build such an aggressive portfolio. Hold 30% stocks instead of 50%. You'll earn a bit less, but you'll sleep at night. The power of emotional discipline. It allows you to stay calm, think rationally, make the right decisions. Why did JPMorgan stay standing in 2008? Because we didn't panic. We stuck to our plan. We maintained a strong cash position. We didn't take excessive risks. Other banks, they panicked, made desperation moves. They sank. What did we do in the 2020 pandemic? While everyone was selling, we reviewed strategy, looked at opportunities, made purchases. Result, record profits. Emotional discipline makes you win. Here are the 5 rules. 1, cash is king asterisk, asterisk. Liquidity is everything. Always keep cash on hand. 2, debt is a tool. Asterisk, asterisk. Good debt enriches, bad debt destroys. Borrow smartly. 3, diversification is protection. Asterisk, asterisk. All eggs in one basket brings disaster. Spread out. 4, stay in time. Asterisk, asterisk. You can't time the market. Stay for the long term. 5, emotional discipline. Asterisk, asterisk. Fight fear and greed. Stick to the plan. I learned these 5 rules over 40 years. I tested them in every economic storm, and they worked every time. Now I've given them to you. But knowledge only has value in application. If you watch this video and do nothing, nothing changes. That's why I'm giving you a task. Today, right now, do these 3 things. 1, check your cash situation. Do you have 6 months of living expenses? If not, make a savings plan. 2, list your debts. Which are good debt? Which are bad? Make a plan to close bad debts. 3, look at your portfolio. Is it diversified or piled in 1 or 2 places? Balance it. If you take these 3 steps today, when the next crisis comes, you'll be ready. And crisis will come maybe this year, maybe next year, but it will come. The question is, when that crisis comes, which side will you be on? Those who panic or those who are prepared? I was prepared in 2008. JPMorgan stayed standing. You can be ready to apply these 5 rules And remember, on Wall Street, the survivors aren't the smartest ones, they're the most disciplined ones. You be disciplined too. I've given you 40 years of wisdom. Now it's your turn. If this video was valuable, like it, share it, and see you in the next video, because there's much more to tell. Take care of yourself and take better care of your money.